Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. We see tech rallying alongside rising rate discussions. Is this a warning sign or is it a sign of growth? The real inflection markets may be waiting for and watching for could be growth, maybe not inflation, says our next guest. What could the pricing situation that's going on with rates right now be telling us about the cycle? And what does the rate environment and potential growth ultimately mean for equity leadership in markets? Joining us here today for another edition of Sector Watch is Denise Chisholm. She is Director of Quantitative Market Strategy at Fidelity. Warm welcome to you, Denise. How are you?
It is warm here, so it is a warm welcome this time. Finally.
It's kind of nice to have a little spring and summer happening and going on here. Why don't we begin with this rates discussion? And it seems to be tied to the oil price. And there's nothing particularly strange about that because the oil price creates inflation in everything that we're doing in our lives in a lot of ways, the driving situation and so on. But does the Fed actually move on this information, on this type of inflation?
Yeah, in some ways, I don't even think that the link is really strong with inflation. I think that we take that narrative as assumed and don't look back in history, right? You can all see that interest rates are going up, so we can observe that. But the rationale behind why they're going up, I think we need to be more open-minded. So first of all, when you look at oil price spikes as it relates to overall inflation, clearly there's an impact. As it relates to core inflation, how often it filters through, over any 6-month period, less than half the time. So that's sort of data point number one, is that more often than not, which is not to say it's threadbare odds, but more often than not, you don't see a pass through. And the more interesting relationship, again, it's monotonic. There's something linear about it. The bigger the oil price spike, the lower the odds over any 6-month period of the Federal Reserve to then go on and raise interest rates. So they almost think of it in the same way that we've talked about it before, which oil more often than not is almost a tax hike on the consumer that might be, just like tariffs, it results in some higher prices, but usually not a broad level of higher prices. So could it be different this time? Absolutely. When you look at the vertical of oil prices up 60%, which is more or less where we are over the next 6 months, you see 25% odds of the Federal Reserve raising interest rates. So it's certainly not zero, and we have no idea what this Federal Reserve will do. But when you're leaning on history, I think there are some cautionary flags to say that most often this isn't the rationale behind why the Federal Reserve is raising interest rates.
And the filter through having it be like a tax in the way that you had described tariffs were, is because it's complicated for companies to pass it through and to even see if they need to pass it through, first of all. But you're getting hit at the pumps, you're getting hit at perhaps a few particular areas within the economy. But as you say, the pass through to sort of the other bits of what people are buying and trading and so on is not there, or we just don't know about it. I guess that's sort of it's a timing issue of how long it all goes on for.
It is a timing issue for sure, but you're already seeing corporate America struggle with the pass-through. And you're seeing this in large retailers who will go unnamed on this webcast in terms of the ability. In some ways, from an inflation perspective, I understand that people are concerned about a resurgence of the 70s and 80s analogs, but in some ways, corporate America doesn't get to decide how much they pass through. The U.S. consumer decides how much they absorb. And if they don't have a meaningful amount of money that's increased relative to what they were just having from a real income perspective, that was the case in the 70s and 80s. That was the case in 2021-22. If there's not an underlying increase in terms of wage growth, nominal wage growth, real wage growth, you just don't see a marginal propensity to consume. So you might end up in this situation where, yes, are there some prices where retailers are trying to pass through? I mean, you could almost look at the, clothing budget of the CPI and say, well, that was up 4%. That's probably a result of higher oil prices. Yes, but quantity demand was actually down over 5% on a real basis in retail sales. So to the extent that there is a response for those higher prices, those higher prices are unlikely to be sticky. And I think that's what history is sort of showing us, which is, again, unless there's a whole lot of money dumped on the US consumer, as opposed to the offsets that we're getting, it's very difficult to see a situation where it ends up in all prices, as opposed to just energy, goods, and services. And because that's been difficult historically, the Fed has been usually not prone to responding to it either.
So another piece to sort of the oil and inflation story is you'll hear Japan, for instance, using its SPR, its reserves in the way that they need to. They bulked up because of concerns of what happened with Ukraine years ago. A lot of countries sort of learned that lesson. And we hear conversations about whether there's a drop dead rate date for companies and countries around the world when they're just going to run out of oil. The date seems to move around a bit. I was just wondering if we're also kind of up against that for an inflationary story.
Well, that goes to the holding all else equal. Remember the running out of oil commentary as it related to 2007? Price will solve that before we ever run out of those barrels. And if price ends up solving it, I can guarantee you there will be response on the rest of the globe. You're already starting to see that in the US because, we started more or less at $60 oil, and as much as maybe $100 oil isn't as high as you would think for a complete blockage of the straits, what you're actually seeing is that's a real economic gain to people who produce oil to the extent that it is sticky there. So there's always a supply response. So don't fall prey to the hold all else equal argument, because high prices tend to cure high prices. And in some ways, an alternative theory, and I do think it's a theory, but we could measure it in a bunch of different ways, is that maybe what the fact that the oil prices is saying is not being as high as maybe people expected, is that there was already a whole lot of oversupply already on the water. So I think that has a lot to do with it as well. And when you look excluding the SPR, we're not really anywhere in terms of inventories relative to demand days in the US that you would say is stretched currently. And this all is sort of wrapped up in a bow of this so far has been very different of losing the ability to produce oil, right? Which is kind of what we were going through in 2007. There was just no more in terms of excess capacity. The problem right now is getting the oil out of the area.
It's there. It's sitting there. But,
exactly.
Right.
And I think that's fundamentally different, right? So when you say that this is the biggest bottleneck and supply disruption that we've ever seen, I would say yes, but. Right. So there is yes, but because the oil is still being produced. And always remember, I think the Suez Canal shut for 7 years, 7 years, maybe even longer. But by the time it reopened, it actually wasn't having any meaningful commerce go through it. So there are alternative ways. Yes, they take longer. Yes, they support a higher oil price, but don't ever underestimate the long-term potential of governments and in some ways markets to actually solve problems that are supply shocks in their nature.
It's fascinating. Weeks ago when the war was new, you had mentioned don't chase oil. This is not the moment to do that. In a sense, that's already passed. And you also mentioned that when it ends, if it ends, when this all wraps up, oil could really drop. And now that you see how much supply is out there, I think you had mentioned you thought there probably was, but now we actually see it. It's almost like a discovery. What is the risk for the oil price to the downside?
Yeah, we always have to hold both tails. I think in some ways equally conscious in our view, right? The right tail and the left tail. So there are all kinds of things that always go wrong. Those are usually the narratives that I talk about a lot when investors ask me things, when portfolio managers ask me things. But there is a scenario where things go well. And there is something that is more like what Venezuela is experiencing, in that if there is maybe a different style of regime, but still a similar regime, that is able to produce at full capacity at some point over the next 5 to 7 years, even if it doesn't happen instantly, you end up with more supply than maybe we started with 2 years ago or 5 years ago if we look forward 10 years. So in some ways, the excess capacity of that ability, if things do go right, and you can say, well, Denise, I know that they're not going to go right. Maybe. We don't know that as investors. That's always the problem. And I like to say, and this doesn't mean to be sort of glib about it, but Goldilocks often has the highest odds, meaning that I'm not saying that there aren't black swan events. There absolutely are, but it's very difficult as an investor to always feel confident enough to bet on them. So if there are things that go right, that could be a situation where oil supply was actually much higher than you thought. And if $60 oil was actually where we were with supply of a year ago, then what does that look like with more supply?
Right, that's absolutely fascinating. So when we get back to the inflation story, what rates are being priced in or not in terms of cuts and actually hikes at this point, it takes you to what a hike ultimately would mean, and sometimes we think that that's to fight inflation. It's not always in your reporting that you've been doing and compiling over the course of the last week. What is actually potentially going on if a hike happens?
Yeah, I would say not only not always, I would say not often. So if you look, again, from a statistical correlation perspective and say, well, it's actually oil price, like we talked about, there's very little relationship. Well, what if it's growth? Which we've talked a lot about, right? The manufacturing recovery that has been in a malaise for 3 years is finally starting to see an inflection. You've seen a durable goods orders number that is actually top quartile, which is fairly rare. It only happens 25% of the time, and usually begets more growth in terms of job growth and profit growth. So you're starting to see an underpinning of a durable expansion that we really haven't seen in quite some time. So is there a relationship between this burgeoning growth and the ability or the inflection in terms of the higher probability of the Federal Reserve to raise interest rates? There, in fact, is. Again, it's monotonic. It doesn't mean it's certain that the Federal Reserve has to raise interest rates. But if you had to bet on a scenario and say, do oil prices usually lead to a more hawkish Fed? Not usually, no. Do higher growth expectations or higher growth prints lead to a more hawkish Fed? Yes, more often than not. And when you look at that and you say, okay, well, let's play this out. Now you're in top quartile growth. You know that growth is actually going to inflect over the next year. And say we had this perfect foresight and the Fed hikes, right? You're right. You get it. You nail it. And you know exactly what the Fed's going to do. What are the odds that the market goes up? In that growth vertical of top quartile, which is, I think, where we are on a lot of the manufacturing indicators from a signaling perspective, you actually have above average odds, and the odds in the market are 75% to go up over any year in either scenario.
Interesting.
Right? So when higher rates are just a reflection of growth, the market has had very little problem with it.
It's completely fascinating how that is filtering its way through. You mentioned that at the beginning, one of the ways to get proper inflation that goes everywhere is governments dumping a whole lot of money into the economy, and that was very much a COVID response for lots of countries around the world. What about the amount of CapEx being dumped into the economy? People will argue it's not going everywhere, but that is growth/inflationary, no?
Yeah, it's interesting. So there's not a whole lot of correlation between growth and inflation overall, meaning that most growth is not inflationary, which sounds a little strange because you would think that there would be some sort of correlation. If the economy grows faster, then you would see inflation. But if you look at the two series, right, GDP, download real GDP over the course of 1962 to present, and you take either the core CPI or the overall CPI, and you say, let's say I get the inflection right. Real GDP inflects, we go from 2% real GDP growth to 4% over the course of the next year. What are my odds that core inflation accelerates as well? It's 50-50. Meaning that not only is there demand increasing, but oftentimes at the same time, supply increases, there's some increase in productivity. There are all kinds of other moving variables that say, again, back to you got to be careful holding that all else equal. We'll say we're going to hold supply constant while demand accelerates. But supply isn't constant. Supply is constantly moving as well. And in some ways, CapEx is correlated to that. So From an inflationary perspective, again, back to the what you can measure, CapEx cycles, however you measure it, and you can measure it a bunch of different ways, are usually disinflationary in nature because there is more often than not a supply response with it.
Okay, that's fascinating. So if we take, what are some of your favorite growth? You're looking at durable goods, you're mentioning CapEx, sort of the investment that companies are making. What else do you need to see? What else are you seeing to help you get to that growth, what looks like a growth scenario taking place?
It is a growth scenario, and I think it's more durable growth than people are giving it credit for. So if you break down durable goods orders, right, orders are sort of the leading indicator, right? If they're saying companies are like, yes, I want more goods, usually that begets the virtuous cycle of more growth in the future, which is why you see other companies having to hire more workers. So you see the statistical inflection that you see. If you say, okay, of the 7 durable goods orders categories that we have, machinery, transports, and then there's 2 that are technology, computers, and I think electrical equipment, because that encompasses semis. What of those 7, how many are actually accelerating? All 7. All 7. And you can measure this historically, and it's interesting. So when you have a top quartile diffuse, I would say, CapEx recovery, manufacturing recovery, we can call it a bunch of different things, right? So that top quartile level is 4 to 7. What does earnings growth look like over the course of the next year? That also has a relationship. The more diffuse the inflection in terms of the CapEx recovery, the more likely earnings growth is to be durable and persistent. So we're still sort of back in this, I would call, secular bull market dynamic of the durability of earnings growth is what I see getting confirmed over and over and over in the indicators that I'm watching. And the more durable earnings growth is, the longer the cycle lasts. That is what drives the secular bull market.
If we bring back in the oil discussion and see it, as we said, drop like a rock, does that suddenly change, for instance, leadership for equities? I mean, does the consumer and some of the struggles that it's going through right now just get solved there? I mean, it's usually not that easy, but is there a case to be made that discretionary or something could move into a leadership position?
There are definitely still the persistent negative correlations between consumer discretionary stocks and either the price of energy or energy stocks themselves as a precursor to that. So you certainly see that sensitivity where you would say, if I have perfect foresight and you know that energy prices are going to drop, consumer discretionary as a sector has had, at least in history, 70% odds of outperformance, either coincident or after that. And I think that this is the area of the market that is struggling the most with passing through price. So you are seeing that margin compression disproportionately more in consumer discretionary than anywhere else. So in some ways, as much as we think of as investors, well, we're looking at higher oil prices and therefore that will degrade margins. It's not clear that that's across the broad S&P, right? Because technology stocks specifically still have a whole lot of pricing power, as do some industrial stocks. So the area that's being squeezed is getting narrow and narrow. So when you look at margins for the S&P 500, there's very little correlation between higher energy prices and lower margins in the future. So that's the interesting part as well. I think that it has, again, less of an impact on what has been resistant to margins, which has been current leadership that I think is still future leadership in terms of technology stocks.
That's fascinating. Bring in Kevin Warsh. He was brought in last week, at the end of last week. It seemed like a smooth handover in a lot of ways. I mean, it's only the beginning, of course, but from what you know from his history and what's sort of been stated, again, what's the case for at least staying on hold because of the person and sort of background that we know? You can't make full predictions, but we'd love to know your thoughts.
Yeah, so I think that he's in a tough spot in the sense where if this is transitory, it ultimately ends up being actually correctly transitory. It's probably too early to know that. Like I said, it's not clear how long this is going to persist. So that there's time for, maybe rate hikes resuming later in the year if we see the impact that we just talked about, a different kind of tail event where oil prices not only revert to where they were, but even potentially head lower. That's a very different situation that, again, we should be open-minded to. But I think that data in terms of playing out is important to let it play out. I do think that something Jay Powell said over and over again over the last year is that the Federal Reserve right now has time. Because as much as we're talking about which way will they go, the level matters a lot as well. And I don't think that where we are right this second in terms of where the Federal Reserve is means that they are well into restrictive territory for the overall economy. There are definitely some pockets that could benefit from lower rates, but there are also in aggregate areas that are offsetting that as well from a growth perspective. So from a balancing perspective, I don't think it's very clear that the Federal Reserve has to move right now. I do think on the flip side of what you think about Kevin Warsh's, I would say ethos has been one of them, which is I think that he can tackle early rather than later, is that forward guidance aspect.
That's really
which is interesting to me because I always say that when you look back through Federal Reserve history is that over the long term, all you see is change. Right? When you look at, do we want to target the discount rate? Do we want to target reserves? Do we want to target a federal funds effective rate? Do we want to actually make a target into it? Do we want to, say that there's guidance in terms of towards 2% inflation? Do we want to have a dot plot? All of these things have been different in any 5 or 10 year increment. So to have another difference where, well, if we look at what we were trying to do was to give guidance so that it could be an additional boost in terms of monetary accommodation, that's probably not necessary anymore. So I think rolling that back is going to be interesting to see how the market reacts to that. Maybe at first blush, there will be narrative around the decline in transparency, but it's also not clear to me that the Federal Reserve had a particularly good track record at being able to correctly forecast inflation. So you're sort of left with the dynamic that we were talking about. Is the Fed more reflective of the cycle rather than creators of the cycle? And if that's true, maybe this whole rate discussion and transparency and forward guidance is a little less of an impact than many think.
I mean, there's an awful lot of Fed speak that's taken over the airwaves over the course of the last several years and probably only been growing over the last several years. So just to think of aspects of that were taken out and less crystal ballism would be really interesting. It sounds like Kevin Warsh has a lot of ideas that you have brought to our attention and others as well about how to restructure things. For instance, how much belongs on the Fed balance sheet versus being perhaps transferred to Treasury seems to be one discussion. Just the discussion about rates potentially needing to hike, or like this new vision of either growth or inflation or something that needs to be reacted to. Does that come first? Can the other things structurally get going at the same time?
I think it probably all comes at once, at least in the early stages of all of it. I think that there's discussions, and there have been discussions on the balance sheet. There already have been discussions about what does it mean to own mortgages? What does it mean to own long-term debt as opposed to short-term bills? What do all these things mean in terms of what that would mean to the reserve requirements of our banks and what that means for regulation? I think these conversations have already been happening. And in some ways, I think people put more of a fine point on maybe there's a disagreement, where I think that maybe the agreement is around the fact that it needs to be tackled. Maybe the disagreement would be on timing and exactly how far. So I think that there's actually more agreement than maybe the market portrays in the narrative. And I think that, yes, balance sheet is an issue, forward guidance is an issue, what rates should be is an issue, both the level and whether or not they hike and lower. And all of those things I think are going to be ongoing over the course of the next year. The question is whether or not all of those things impact the market. And the interesting thing to get back to the Federal Reserve is, I think that the pushback on my view is to say, yeah, Denise, I know what you're saying, but we just did 2021, 2022. If you're wrong on inflation and the Fed has to hike a lot, I know you just said that the Fed hiking was more often than not a reflection of growth, not a deterrent to it, but that seemed like a really bad setup. That's where magnitude matters. So when you say, yes, they have to chase inflation, we just talked about why I think that there's not going to be a significant amount of pass-through. From a magnitude perspective, that would be problematic. But if you say, well, the Federal Reserve is going to hike, 25, 50, maybe even 100, that's in these middle two quintiles of history. So it's sort of more like just incremental in nature. That's actually the sweet spot for the market. So this whole, what we're talking about in terms of narrative, I don't want to say it's a sideshow in the sense that it's not important and it's not important to discuss, but it might not be the critical driver that you think it is for the overall market.
That's fascinating, because it really, you do kind of wonder how that filters through and comes through. One question I wanted to ask you, just going back to the consumer, the potential for the consumer to have less of a burden should oil prices come down. We don't know about that. But as this AI cycle continues and you watch where things are being affected, we've heard some comments that ultimately the growth could be coming more from sort of business to business discussions rather than very sort of consumer-led industrial revolution talk. I mean, I only ask you that in the sense that you wonder if this is more sort of an industrials or a consumers discussion. We both know both of our countries are heavily dependent on the consumer to drive the economy, and that's just the way it is. Is there something you see there shifting at all with what we know so far about the impact of AI?
So I think what we're seeing, right? So who knows how it ultimately will impact, but what we're seeing that we can actually measure is that most of industrial production or consumption, I would say job growth, a lot of the leading indicators are pointing to accelerations across the board. If you had to pick one and say it's more dominant in manufacturing or it's more dominant in the consumer, right now the leading indicators are saying exactly what you said. It's more dominant in manufacturing. You're seeing a really strong inflection in NAPM new orders or ISM new orders. You're seeing this durable goods order recovery. So the question is that a bad thing for the overall either market or future growth? And the answer is no. Which is not to say that the consumer isn't a big portion of the economy. It's just to say that I think we're in a vertical where industrial production, on average, grows faster than consumption. As long as both grow, that's the trajectory. So in some ways, like, growth is always somewhat concentrated. There's always some sort of leadership dynamic about it. And I think it's always interesting when we talk about, well, growth is in, I just saw a headline in the on one of the news stations that the top 17 now encompass, 50% of the earnings growth. And I feel like we keep saying, like, is it FANG? Is it, Mag 7? And now we're talking about the top 17. All of that is a function of the fact that growth is good. And it's actually accelerating by and large everywhere. The fact that it's really strong in pockets doesn't have to be a negative. And I say it doesn't have to be a negative because you can figure it out historically. We can look at when these pockets have been strong in growth and everybody else has been a little weaker in growth, but still growing. And that's not a driver for the overall market because there is growth. And if growth underpins the durable earnings growth, then durable earnings growth always underpins a secular bull market.
That's absolutely fascinating. Talk to us a little bit. You mentioned this about being in the sweet spot and how that ultimately works. In terms of growth and alpha and sort of the stock picking discussion here and making sure that you're going specifically into particular companies to beat benchmarks and so on, how does growth work with the alpha story? What do you need in terms of rates and then taking a look at the growth story?
Yeah, I'm not sure there's any difference in terms of leadership, what we're seeing. I think that there's a big narrative around a short-term correlation between technology stocks and rates, meaning that, over the last 18 months, lower technology stocks or underperforming technology stocks have been correlated with higher rates. The question is, when you look back in the data, is that persistent? Those short-term correlations, we assume that we know the answer in terms of how they'll close or the risk. But again, we don't have to go far. We can download the data and we can say, okay, if we have perfect foresight and we know that rates are going up, but the growth position is strong, as I said, from a quartile perspective, if you say, okay, we've got either above average growth or below average growth, and then I have perfect foresight and I know rates are going higher or lower, you see two really interesting things in history for the technology sector, is that one, higher rates are, both verticals, better than lower rates, not worse. So that short-term correlation hasn't been persistent in history. And the more interesting part is that what you see from a higher growth perspective and lower rates, what you would expect maybe the best performance to be, is the worst performance. It's odd. It's almost like what we're talking about. Rates confirm growth, rather than derail it. And rates kind of get it right in terms of the overall cycle dynamic. So where we sit now with technology stocks being strong growers, and by strong, I mean above average earnings growth, when you look back in history, and with perfect foresight, rates go up, you have average outperformance of, I think, 500 basis points on a rolling basis, and they outperform about 65% of the time. That's before you include valuation, which boosts the odds close to the mid 80s. Right. And that's been the differentiation this cycle, which is earnings is very strong in the technology sector, so strong that even if you include the rally we've just seen, the stocks are still in the cheapest half of the distribution when you look back to the 60s. And that, again, back to those sort of monotonic linear patterns that we always want to give an eye towards, the cheaper the relative valuation of technology stocks, the more likely they have been to outperform. So you've got really good starting points of leadership. So does it change leadership? My answer would be no, to the extent that rates confirm the growth that we're already seeing. Even if rates are higher, especially true relative to our starting point on valuation, I think the risk reward in terms of technology stocks is still positive.
Don't fear the hike as long as it's not too big.
Right.
It confirms
Well
that
said.
fascinating data that you bring to us. Denise Chisholm, thank you for joining us. We're always so happy to be able to listen to your insights. Have a great rest of your day.
It was great to be here.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.